It seems like Tom Lee is starting to capitulate as well. Even though he has been bullish and has not really deviated from that, he does now say a lot of risks between now and the election. That election correction he was calling for, or at least election volatility he was calling for, may not actually come. In this new interview posted to CNBC today, it's titled, "I've underestimated how strong this market's been." Tom Lee does go on to say that there are some warning signs of volatility, like the VIX being close to 20. He says this should fall to about 15 after the election, and that's more where the VIX should be, is around 15. We have a lot of other news to cover as well for markets. Markets are hitting a new all-time high today, but first, let's share this clip from Tom Lee, posted today.
Following last week's inflation data, Tom Lee's here, managing partner and head of research at Fundstrat Global Advisors, as well as a CNBC contributor. Tom, in recent appearances, I would say that your conviction hasn't necessarily been quite as strong as it had been in some of your other calls, where there's been a time where you said the inflation data will be so good that the S&P will be up 200 points in the next week, and it panned out, and it played right into what you were saying. The last time you were on, I think your basic thesis was that market's still solid through the end of the year, but in the meantime, there could be some volatility and maybe even a pullback. Now I think you're saying it's been more stable than what you're expecting, and it has to do with liquidity and cash on the sidelines more than anything else.
Yes, that's right. You're right. We've kind of been sort of, I think, fooled by seasonality because we thought markets would be hesitant before, the elections, and it's October. But we've seen this market be incredibly resilient. So I've underestimated how strong this market's been. I think it really shows macro data is becoming less important, and it's now the fact that a lot of cash has been on the sidelines. For the last 2 years, investors expected a recession, or many thought when the curve uninverts, we got a recession. But at the end of the day, there's $6 trillion of cash on the sidelines, and October has turned out to be a great month.
We've seen it, evidence of what you're saying, and I know how closely you watch it. We've seen it on a daily basis over the last, I'd say, maybe month or so, where many days we're even down triple digits in the futures, only to end up 250 or 300 points by the end of the session. And with no backdrop of positive news, nothing to account for it, other than it seems like there's money on the sidelines that's coming in.
I mean, it feels like investors are underinvested in stocks. I think there's people who've dreaded 2024, thinking this is the year we slip into a recession, and instead, and we're seeing it with earnings, companies have been really resilient.
Yeah, we waited and waited to retest the lows a couple of times in 2022 and 2023, and people weren't bullish at all. We didn't get great advances, and now it's almost unstoppable. And nothing seems to be able to knock it off a track, whether it's, I think the PPI and CPI were both a little hotter than people thought. The prospects for a Fed continued easing cycle are now open to some conjecture, I think, although most people say it's still going to happen, even though things are pretty solid in both the economy and the stock market.
Yeah, I think it makes sense for the Fed to be dovish, just because inflation is still tracking, especially PCE, towards their 2% target. And now we have some concerns about the job market. So I think the Fed has to be supportive. And I think this election, which is becoming less of a coin toss, I think because it's been a coin toss, people have been sitting on their hands. I think these are reasons markets are starting to have conviction, even in front of an election event.
I think we've soft pedaled it too. The swing states have even some of the swing states that looked like solidly in Harris's camp are now truly swing states where Trump's up in Michigan and Wisconsin, and betting and everything else. And if NBC goes from Trump up, or from Harris up 5 to Trump and Harris tied, and then you do a full field and Trump is actually up in a full field thing. So I think you might be right. Bitcoin's at 65,000. You wouldn't say that the stock market's performing better because it's starting to look like it's less of a coin toss, would you?
I think markets like visibility. So if it looks like one candidate is now looking like to be the surprise winner, then markets can actually trade better before the election.
Wait, does it matter? You said markets like visibility. They have to like what they see on the other side of it, I would assume.
Yes. I mean, I'm probably just citing market history, but whether Trump or Harris wins, I think stocks do pretty well next year, sort of a post-election rally. But there are definitely differences in sectors and asset classes performance depending if Trump or Harris wins. But Bitcoin, for instance, is something to watch if Trump looks like he's strengthening because Trump is running on a pro-Bitcoin platform.
All right. Now, you said something, we'll get off of that, the politics. You said that you agreed with almost the asymmetric risk now. And I still think it could go the other way. I mean, I think the labor market looks pretty solid given that last report, and that we're still, if PCE is 3%, it's got to go down another 33% to hit 2. And they swore they're not moving the goalposts. It's 2. It's 2. It's 2. It's not 2.5, Tom. It's 2.
Yes.
And what makes you think that that's in the car? Who knows with the Middle East and everything else? But oil's back to mid 70s and could go higher.
Yes.
I'm more worried about it. I don't know. They're more worried about the jobs picture than stubborn inflation.
Yeah, I mean, you're actually right. Oil spikes can cause an inflation spike, and that would be a surprise. But if we look at what's been keeping inflation stubbornly high, it's been shelter, which in the latest inflation report finally is rolling over, and it's auto insurance, which is now just beginning to sunset. So in the second half, auto insurance becomes a tailwind. And then the question would be, are core goods going to stay under pressure to kind of bring overall inflation down? And it looks like core inflation, on goods, looks like it's going to remain soft. So I think inflation doesn't have the upside drivers except for what you're saying, a commodity shock.
So I don't know about you guys, but it seems like even Tom Lee is starting to doubt whether or not this market is going to go down in any kind of meaningful way anytime soon. This is growing more and more the consensus call. It seems like everyone is bullish lately. I mean, after all, markets are going pretty much straight up, which is actually weird because if you look at earnings estimates for Q3, they have plummeted ever since June. Really, July they started to plummet. Q4 earnings estimates have been plummeting ever since August, and 2025 earnings estimates have been plummeting ever since about late September. So why are markets going higher? Historically, stocks move up as earnings estimates move up. Stocks move down as earnings estimates move down. A lot of this recent leg higher in markets could really be attributed to big tech, specifically Nvidia, that is almost now at a new all-time high. Nvidia is less than 2% away from an all-time high. You're up 3% today alone. Apple's up 1.3%, Meta's up 1%, Google's up 1.2%, Microsoft up 1%. This is really carrying the brunt of the markets. Ever since 10-year Treasury yields on September 18th, when the Fed cut rates 50 basis points, have since risen over 65 basis points, it has forced a lot more crowding into big tech. But it's actually fascinating because big tech earnings estimates are also going down. And that's why I've said here on this channel, I think you're seeing a lot of upside capitulation. I think you're seeing a bit of a short squeeze out there where some investors that were short are saying, this is just too much pain, we're gonna cover, we gotta go long. Much the same way as downside capitulation tends to mark the bottoms, this feels like a lot of upside capitulation. And I still think we are in a vulnerable position if, let's say, this week's initial jobless claims go up again, or next month's payroll report shows the labor market's not as strong as we thought. Because there is this gap growing, there is this disparity growing between markets moving higher, earnings estimates falling, and who knows where the economy is in between. Fundstrat on X gives us an early preview of what we've seen so far out of earnings season. You've only had 6% of the S&P 500 that has reported earnings, only 31 companies. Overall, 74% are beating estimates, and those that beat are beating by a median of 6%. Of the 23% missing, those are missing by a median of negative 10%. That is huge, okay? On the top line, overall results are beating estimates by a median of 2%. That's weak, and missing by a median of negative 2%. And 58% of those reporting are beating estimates, which is on the low side as well. But again, keep in mind, the reason why companies will beat Q3 earnings is because Q3 earnings estimates are plummeting. Like for some stocks, the bar may be set a little higher, like Nvidia, after now almost hitting a new all-time high. You can imagine the estimates are a little bit higher there. But as an aggregate, estimates are, again, plummeting, which is not exactly supportive of equity markets. But overall, I do agree with Tom Lee. I've never been in the camp that we needed to see an election crash or an election correction. I think the election is the last of our concerns. Q3 earnings, the Fed, the economy, geopolitical tensions, and ramifications for the energy market. These are top of mind. The election is really an afterthought. Whereas that's a little bit different compared to other election years where the election is really the main story most of the time. You can also see this lack of fear represented in high-yield junk bond credit spreads that have not been this tight since June of 2007. There is currently no perceived market risk. Kind of doesn't make a whole lot of sense, considering the Fed just embarked on the fastest tightening cycle in almost 50 years. But in just 2 weeks, the market will enter the best 6-month period to own stocks. November to April, no more sell in May and go away. I'm sure you've heard that many times before. You have a positivity rate of 78% during this period with an average 6-month return of 7%. But the options market is pricing in the largest post-earnings move for single stocks since at least 2021, according to Bank of America's research. You can also see this reflected in the options market for the SPY, which is the ETF for the S&P 500. If you go out to the mid-November, end of December options, they are pretty expensive. They're pricing in a big move to the upside or to the downside. It was also reported last night, the German economy is now likely in a recession with no more growth seen this year, per Bloomberg. As Chuck Hodels writes, likely in a recession because nobody can agree on the definition and everyone keeps changing it, which sounds pretty accurate to me. Nevertheless, we have finally done it again. The CNN Fear and Greed Index is now in extreme greed, coming in at 77. Yesterday, well, Friday, you were at 74, which was on the edge of going into extreme greed, but technically still in greed territory. Market momentum, extreme greed. Stock price strength, extreme greed. Stock price breadth, extreme greed. Put and call options, greed. Market volatility, neutral. Safe haven demand, extreme greed. And junk bond demand, in greed. Over on StockTwits, sentiment is neutral for the SPY, coming in at 48. On Friday, you were bullish at 57. So some investors may not be buying this blow off top rally. People are really not getting more bullish. They're kind of neutral. They're kind of weary of this. Message volume is normal at 45. Yesterday or Friday, you were low at 31, and the participation ratio is high at 56. I will also point out the volume today is extremely low. Today is Columbus Day. Banks are closed, bond markets are closed, big money investors are really not in the office today. This is all algorithms. This is all retail investors accounting for the volume. We are getting towards the end of the day. We have less than 2 hours left in the trading day, and S&P 500 volume is only at 15.7 million. On Friday, you were at 42 million. And on the last red day we had on October 7th, we had almost 50 million in volume. So we are very low. On September 19th, for an example, you had 77.5 million in volume on the SPY. There's just no volume today. And when there's very little volume, markets tend to follow the path of least resistance, which is to the upside. Now, Fed Kashkari had a couple things to say today. He says the neutral rate is likely higher now than pre-pandemic, something we've heard many times from the Fed, but he also says that the neutral rate will rise if U.S. debt continues to rise. So from that logic, the neutral rate will always rise because the U.S. government debt will also always rise. Fed Kashkari says monetary policy is still in restrictive stance, and he does say that the neutral rate is likely higher now than where it was pre-pandemic. Fed Kashkari does reiterate that further modest rate cuts appear appropriate. And for the first time in 22 years, bonds are yielding more than stocks. The 10-year Treasury yield is higher than the S&P 500 earnings yield, which the last time this happened was in the early 2000s. Also in the news today, China may issue $6 trillion in yuan treasury bonds over the coming 3 years, which equals about 850 billion US dollars to help fund their aggressive stimulus efforts. Share buyback announcements for 2024 are shy of 1 trillion and are at a new record. 22% of all buybacks will be executed in November and December. So again, I just want to point out US high yield credit spreads being the tightest they have been since 2007. I really want to just emphasize, with markets not pricing in any risk, if we get bad economic data, if we get worse than expected earnings, if there is more risk that needs to be priced into markets, which I believe there is, I don't think these spreads are accurately reflecting the balance of risks between recession or soft landing. It just doesn't make a whole lot of sense. So if we start to get bad news, the markets are in a very vulnerable position. And no, I'm not saying we have to get bad news or we will get bad news. I think the odds that we do get a further slowdown in the economy, that last month's employment report was a one-off, kind of a head fake, I think the odds of that are at least 50-50. I mean, correct me if I'm wrong. Over 80% of the time the Fed goes into a hiking cycle, we end up in a recession. So why is there zero chance of a recession priced into markets? It should at least be 50-50. I think that's generous given the historical precedence of 80+% we go into a recession. I mean, I think I'm the logical one here. Now, yes, is the Fed going to backstop things? Is there going to be stimulus? If that's what needs to happen, of course. But between then and where we are now, if things weaken, that just means downside for stocks in the intermediate term. Now, when this downside comes, I do not know, but I can tell you right now, there's a bit of a short squeeze and upside capitulation going on right now, which does not tend to last that long. And for the last couple of months, I've really talked about the markets are probably going to do well up into the election. It's after the election I'm a little bit more concerned with. I think the economic data may start to weaken or worsen after the election, and I think the holiday shopping season is really not off to a great start. And again, I do think if we can get to April of 2025, get March economic data, the March jobs report out the way, and we're not in a recession or not experiencing a steeper, more severe slowdown, then we can declare this was a soft landing. But not until then. But I do think there are opportunities in our markets. I think there are areas that are priced for a recession that will re-rate if we do have a soft landing. These are consumer cyclicals. These are some select software companies. These are small caps, right? These are the areas that are beaten down, that are unloved right now. A lot of them happen to be dividend payers, so you get a sweet, sweet yield as well. And I think the upside will be focused in those areas if we achieve a soft landing, because everywhere else has already priced in a soft landing. These are companies like Dollar General, like CVS, like Humana. These are CRISPR, other small caps, Tesla, right? Some of these companies are not super exciting. They're kind of boring, but that's where the opportunity is in our markets right now. And there will be a season for the exciting stocks, for Nvidia, for AMD, for Google, Apple, Microsoft, all these fantastic companies. There will be a season in which those will be unloved again. That will be the time to buy those. But I don't think that's right now. I think expectations are way too high, and they are indeed not pricing in any risk to the economy, which, yes, you've seen like 2022. They will fall if economic, concerns start to come out. In fact, everything will fall if it looks like we're going into a recession. And I think there's a reason why Warren Buffett has the largest cash position he has ever had in the history of Berkshire Hathaway. I don't know, call me crazy, call Warren Buffett crazy, but I guess time will tell. Let me know what you think about all of this information down below in the comment section. Have a safe and great rest of your day. I will see you in the next one.